tried to calibrate the impact of uncertainty by thinking about a previous sterling event when sterling was booted out ignominiously of the exchange rate mechanism. At the beginning of this process here, sterling was assumed it was going to join the euro. At the end of this process, the euro was formed and sterling was not a part of it. During that whole period of time, the risk premium on sterling assets fell, in our judgment, by 200 basis points. That's what that dotted arrow indicates. Why did it fall? Because we've just created a new currency we know nothing about. All the opportunities to hedge against things like bunds or franc or whatever, the pre-euro currencies, were gone, save for one, and the one was sterling. And the fact that sterling was out and a known quantity, and the euro had just been formed was an unknown quantity, meant that the risk premium on sterling assets fell by 200 bips on our measure, which gives us an upper bound of how far it might increase this time. If it were to increase by 200 bips this time, then you would expect sterling to fall sharply, you would expect equity prices to fall sharply and other risk assets in the UK to sell off too. And that is exactly what's happened, albeit not as far as would be consistent with 200 bips just yet, maybe half that far, which implies to us there may be half as much to come again. Thinking about the currency side of that, one reason why we think the currency might fall even further is this chart, and this is a measure of how much more we import than we export, expressed as a share of GDP, plus other identities on the current account side as well. The point about this number, 5.4% of GDP deficit that the UK was running in 2015. 2016 looks more like it's going to be 7% or numbers like that. And again, we've never seen a deficit this large in our peacetime history. We've never been more in hoc or borrowing more from abroad than we are now in all of the UK's recorded economic history back to 1830, which is a really stunning result. It says the economy's overheating. It says the currency is uncompetitive and needs to fall in value and fall quite a long way, maybe up to 35%, in order to put this all the way back to balance. We don't necessarily see that as being necessary, but a further 10% fall maybe in sterling over and above what's already in place maybe it is on the cards. The biggest deficit is with our European colleagues, the blue line here. With the rest of the world, sterling, UK doesn't really run a deficit, it's broadly been in surplus. The big deficit is with the rest of Europe. Sterling needs to fall, and it needs to fall in particular against the euro. Whether it can achieve that remains to be seen.